If you've spent years building up your RRSP, maxing out contributions, taking the tax deductions, watching it grow, you probably feel like you're doing everything right. And in many ways, you are. But there's something most Canadians aren't told. That same RRSP could trigger one of the biggest tax bills of your life after you're gone. I'm not talking about a few $1,000s. I'm talking about hundreds of thousands gone in a single tax year. Here's how it happens. You pass away with $500,000 or more still in your RRSP or RRIF. There's no spouse to transfer it to. The government treats the entire amount like income and taxes much or all of it at the highest rate. That means up to half your retirement savings could go to the CRA instead of to your children or the legacy you intended to leave. And the worst part, it's often completely preventable, but you have to know the risks and plan ahead. So in this video, I'm going to walk you through exactly why this happens, who's most at risk, and most importantly, how to protect your savings from getting taxed away at the end of your life. Hi, I'm Darcy Bell, Certified Financial Planner Professional with IG Wealth Management. I help Canadians grow, protect, and optimize their wealth, especially during retirement. If you're watching this, chances are you've worked hard to build up your RRSP, and you want to make sure that money supports not just your lifestyle, but your legacy too. Before we dive in, make sure to like this video, leave a comment if you've ever worried about taxes in retirement, and hit subscribe so you don't miss future strategies on retirement and tax planning in Canada. Now let's talk about how to avoid one of the most overlooked tax traps in Canadian retirement planning and keep your wealth where it belongs with your family. Part 1. What happens to your RRSP when you die? Let's start with the basics, because most Canadians have no idea what actually happens to their RRSP when they pass away. And the truth is, it's not pretty if you haven't planned for it. Here's how it works. When you pass away, the full value of your RRSP or RRIF is considered income all at once on your final tax return. Let's say you've got $400,000 sitting in your RRSP when you die. The CRA doesn't see that as a lifetime of savings. They see it as $400,000 of income in a single year. And that's a problem, because the minute that amount hits your return, you've bumped into the highest federal and provincial tax brackets. In most provinces, that means you're losing 45 to 54 cents on the dollar. So instead of your family receiving that full $400,000, they might only get around $200,000 to $220,000, and the rest goes straight to the CRA. Now, there are a few exceptions, and this is where people get confused. If you have a spouse or common law partner, your RRSP can usually roll over to them tax deferred, meaning there's no immediate tax bill at your death. It just becomes part of their RRSP or RRIF. But here's the catch. When they pass away, unless the money rolls over to another eligible dependent, like a financially dependent child or grandchild due to an impairment in physical or mental functions, that full amount will be taxed just like it would have been for you. It's just a delay, not a solution. And if you're single, widowed, or divorced, there's no rollover. That RRSP gets taxed immediately, often at the highest possible rate. Let me give you a quick real-world example. I met a client whose father passed away with about $600,000 in his RRIF. He didn't have a spouse, and the RRIF listed the estate as the beneficiary by default. No planning had been done, no adjustments made to offset the tax. By the time probate, legal fees, and income tax were taken into account, the family ended up with about half of the original value. And the CRA, well, they got the other half. The saddest part is, this was a man who had worked hard, saved responsibly, and never overspent. He thought he was doing everything right, but without the right planning in place, the tax bill undid so much of his good work. And this happens more than you'd think. If your RRSP or RRIF is one of your biggest assets, and for a lot of Canadians it is, then ignoring what happens at death can cost your estate hundreds of thousands of dollars. So now that we've talked about how the tax works, let's move on to why this catches so many families off guard and what you can do about it. Part 2, why this catches so many families off guard. So now that we know how the tax rules work, the big question is, why do so many Canadians miss this? Why is it that smart, responsible people who saved diligently for their whole lives, still get blindsided by a massive tax bill at death? There are a few key reasons, and honestly, None of them are your fault. The first reason, RSPs feel like free money for decades. Let's be real, RSPs are marketed as a win-win. You put in money, you get a tax deduction, and your savings grow tax deferred. And all of that is true while you're working, but what no one emphasizes is the flip side of that deal. The government lets you defer taxes now because they're planning to collect it later. And later often ends up being the moment you pass away, which, by the way, is when the tax bill hits the hardest. Second reason, most people never see a projection of their tax at death. Think about it. When's the last time someone showed you what your RRIF will be worth in 10 or 20 years if it keeps growing? How much of it might be taxed at death? And what your kids or beneficiaries would actually receive? Most Canadians never get that kind of modeling. They look at their RSP or RRIF balance and think, that's what I'll pass on. But the real number, the after-tax number, is often 30 to 50% less. If you don't see the numbers, it's easy to miss the risk. Third reason, a lot of people assume their will takes care of everything. This one's really common. They figure, I've got a will, I name my spouse or kids, I'm good. But here's the thing, your will doesn't stop the CRA from taxing your RSP. Your RSP is taxed before your estate gets distributed. Even if your will says, I leave everything to my children, the CRA still gets their share first, unless the assets are structured properly and the right beneficiary designations are in place. Fourth reason, no one tells you what happens after the second spouse dies. Let's say you've done a great job and named your spouse as the RSP beneficiary. No tax when you pass, great. But what happens when they pass? Everything in the RSP or RRIF becomes income for them on their final return. No more rollover, no more deferral. That's when the tax hit often happens, after the second death. And that's when your adult children or beneficiaries end up surprised and frustrated. And finally, most people simply never talk to anyone about it. This is no one's favorite dinner table topic. No one wants to think about death, taxes, or what could happen 20 years from now. So people put it off. They focus on investments, on saving, on the day-to-day. And when it's too late to make changes, that's when the tax bill shows up. So here's the bottom line. It's not enough to just grow your RSP. You have to know how it fits into the bigger picture, how it affects your taxes, your income, and ultimately your legacy. And the good news is this is completely fixable. You just need to start early, understand your options, and put the right pieces in place. So in the next section, we're going to walk through practical, real-world strategies to reduce the tax on your RSP and keep more of your wealth with your family. Part 3, how to reduce the tax on your RSP at death. So now that we know what happens to your RSP when you pass away and why so many people miss it, let's get to the good part. What can you actually do about it? Because here's the thing, this isn't just bad luck or something you have to accept. There are real, practical steps you can take right now to reduce the tax burden on your estate, sometimes by hundreds of thousands of dollars. Let's walk through some of the most effective strategies. Number 1, start withdrawing from your RSP earlier than you think. Most people want to delay RSP withdrawals as long as possible. Why take out money now and pay tax when I can wait? But here's the problem. If you wait until 72 when RRIF withdrawals become mandatory, those withdrawals can be huge. Add CPP and OAS, and suddenly you're in a much higher tax bracket than you planned. That can increase your annual tax bill, trigger the dreaded OAS clawback, and leave a big taxable RRIF balance behind when you pass. Instead, consider withdrawing earlier in retirement when your income is lower. You'll pay less tax now and reduce the balance that could be taxed at death. It's called tax smoothing, and it's one of the smartest moves retirees can make. Number 2, use your TFSA strategically. The TFSA is one of the best tools we have in Canada, especially for estate planning. Why? Because it grows tax-free. Withdrawals are tax-free. And when you pass away, the money goes to your beneficiaries tax-free. If you're drawing from your RSPs or RRIF each year, consider reinvesting what you don't need into your TFSA. This helps you shift money from a taxable environment, the RSP or RRIF, into a tax-free one. And over time, it can make a big difference in how much your family keeps. Number 3, name the right beneficiaries. This one's simple, but so many people get it wrong. You want to make sure your spouse or common law partner is listed as your successor annuitant on your RRIF or as the beneficiary on your RRSP. This allows the account to roll over to them without triggering tax when you pass. If no spouse beneficiary or other qualifying survivor is named, you're handing the CRA the full tax bill the moment you pass away. So take 5 minutes, log into your accounts, and double check your designations. It's one of the easiest ways to protect your savings. Number 4, consider gifting or income shifting while you're alive. If you're in a strong financial position, you may not need all your RSPs or RRIF income in retirement. In that case, consider gifting money to adult children or grandchildren while you're alive, helping them with a down payment, education, or investing, gifting funds to your spouse or child to contribute to their own TFSA if they have room. This strategy won't reduce your taxable income immediately, but it gets money out of your estate and potentially into a lower tax environment. And let's be honest, giving when you're here to see the impact can be a lot more meaningful. Number 5, use permanent life insurance to offset the tax. I know life insurance is not everyone's first thought in retirement, but in the right situation, it can be a powerful tax tool. Here's how it works. You use a small portion of your RSP withdrawals or retirement income to fund a permanent life insurance policy. When you pass, your estate receives a tax-free payout, which can be used to cover the tax owing on your RSP or RRIF. So instead of your family selling off investments or losing half the account to tax, they get a clean solution. Now, this isn't the right move for everyone, but if your estate is going to face a large tax bill, life insurance might be worth considering. Number 6, make a charitable donation from your RSP. If you have a cause you care about, this strategy is both generous and tax smart. You can name a registered charity as the beneficiary of all or part of your RSP or RRIF. When you pass, your estate gets a donation tax credit, which can offset or even eliminate the taxes owing on the account. It's a way to turn what would have gone to the CRA into a meaningful gift on your terms. Let me give you one quick reminder. You don't have to do all of these, but even just 1 or 2 small changes can make a big difference over time. The key is to start early, get advice, and build a plan that reflects your values and goals, not just a default that ends with a giant tax bill. Next up, let's walk through a real-world case study so you can see exactly how this kind of planning works in action and how it helped one Canadian retiree keep more money in the family. Part 4, a quick example of how planning can save you $200,000 plus. Let's look at a real-world example. Sandra is 78, widowed with $600,000 left in her RRIF. She wants to leave that money to her 2 kids, but without planning, that $600 will be taxed at 50% when she passes, meaning her estate keeps around $300,000. The rest goes to the CRA. We reviewed her situation and made a few changes. We started drawing slightly more from her RRIF now to reduce the balance. We used the excess to fund her TFSA and gift money annually to her kids. We set up a small permanent life insurance policy to cover the expected tax at death. The result? Her estate now avoids a huge tax shock and her kids receive a much more meaningful inheritance. Planning changed everything. Part 5, what you should do next. If you've built up significant RSP savings over the years, first of all, congratulations. That's no small feat, but now's the time to make sure all that hard work doesn't get lost to tax. Here's what you can do. Review your RSP and RRIF balances with your advisor. Understand your projected tax bill at death. Make sure your beneficiary designations are up to date and explore strategies that help you and your family come out ahead. If you want help building a retirement and estate strategy that protects what you've worked for, click the link in the description to book a free, no obligation consultation with me. We'll sit down, look at your numbers, and build a plan that keeps your wealth where it belongs, with your family. And if you found this helpful, make sure to like the video, drop a comment, and hit subscribe so you don't miss future retirement tips. Thanks for watching, and I'll see you in the next one.